gold. What makes gold prices? What's the desire for gold? Why people need to buy gold? Often it's a safe haven. Bitcoin role is complete risk on. Though AI is a new thing, it's not really a new thing when it comes to trading.
This was in 2008.
2006 I started. It was trading with $635 an ounce. In 2008 was the first time it passed 1,000. Again, it's just understanding what role gold is playing in that time. Is it safe haven for economic issues or safe haven for geopolitical issues? Safe haven doesn't mean it's a guaranteed investment, which the market's, a bit scary, the stock market's looking a bit shaky, let's put our money into something a bit safe, what they class as safe havens.
Welcome to the Financial Frontiers podcast. Remember to subscribe to our YouTube channel, hit that bell icon to get notified when we upload new content. Follow us on Spotify and give us a 5-star rating. It will help the channel, which I hope you love so much. Here we are, another episode of the Financial Frontiers podcast, and today my guest has got a challenging surname. I'm going to try not botch this one. James Trescothick.
Nearly. It's James Trescothick.
Trescothick. I botched it.
Good effort though, not bad, not bad.
James Trescothick, thank you very much for joining me today, James. Head of Market Research, strong on fundamental analysis, strong on technical analysis. You're currently at One Royale, 20 years of experience based on the island. I'm looking forward to a good conversation over here in the industry that this podcast initially started on. James, thank you for your time. Feel free to introduce yourself. Let's get into a conversation over here and open up different topics.
Excellent. Well, first of all, can I just say a big thank you for having me on your podcast. I really appreciate it. And the pleasure is all mine. Absolutely is. Just to give you a brief rundown on who I am. Obviously, like I say, my name is James Trescothick. I'm a head of market research and market analysis at One Royal. And for my sins, I have been in the industry for coming up to 20 years now. Hence the wrinkles and the grey hairs and all this. And during my time, I've seen many changes, many things which have evolved in the industry. But even though I don't like some of the things which are involved, I love the story of the markets. I'm a market guy at the end of the day. I love the markets, and this is why I do what I do. But anyway, thank you once again. I'm looking forward to a really good conversation.
Yes, excellent. So run us back your experience, and I think, you know, I always like in these podcasts, I start off the journey, you know, of each of my guests in the profession. It's good to tap into that history. You know, how did you build your career to where you are today, and then with that context, then looking forward, you know, how do things change moving forward, and walk us a bit back, your initial steps in this industry, and has it been primarily, you know, straight into this market research, never veered into different roles in the industry, or maybe completely different industries? Walk us back a little bit, and let's take us through this journey.
Absolutely. Well, I started off obviously at an early age in the financial service industry. I've been in the financial service industry from the age of 18. I actually was a qualified independent financial advisor, and I actually specialized in mortgages back in the UK. You know, mainly for commercial properties, things of this nature. When I moved to Cyprus back in 2006, the mortgage industry over here was very different. The bank system was very different. And in many ways, the clientele we dealt with are very different. Expats, so very different from Brits in the UK. And to be honest, I hated the industry anyway. So I came across a junior level for an international commodities brokerage. You know, like we started from the very beginning, boot camp, training, obviously sales. Okay. And I always wanted, in many ways, to go into sort of financial investments because I always had an interest when I was young from watching the movie Wall Street when I was, about 9. I never understood what was going on in Wall Street, but I found it really exciting. So I always had a sort of an ambition in some ways to get into stockbroking. I wanted to do 2 things, a filmmaker or maybe stockbroking. And this looked like a great opportunity for me to get into this type of field. So I started off, obviously, boot camp, junior, learning the trade. And back when we started with this little commodity brokerage, which was trading through the Dubai Gold and Commodity Exchange in Dubai, which was a small exchange at the time, the only main commodity we traded or we focused upon was gold. And I learned part of, obviously, the sales pitch and part of the investment was talking about fundamentals which drove or drives gold prices. And once I started to understand the storytelling behind it or the mechanics behind what makes prices move and why it's important to everybody, the prices of assets in the market, I sort of became obsessed with it. And from then onwards, I started a career within this industry. Obviously started off in sales, got more training, became a lot more obsessed with market analysis, and did a lot more of that especially with sort of more portfolio management later down in my career. Then I went into obviously dealing, so I understood pricing, execution, and things of this nature. Back into marketing, back into doing market analysis, back into education. And, I've even been a director of a SIF as well. I've done a whole rounded part of this industry. But my main passion has always been, and always will be, talking about the market, because that's what excites me. And that's what I enjoy doing. So, in many ways, I'm full circle back to doing what I really like.
Cool.
Talking mainly about gold, really, because it's the love of my life. It's, my first thing I ever traded. So, yeah.
Do you actively trade?
I'm not myself personally at the moment, no. I have done for a number of, for myself and for a number of other portfolio managers as well. Now I tend to focus more on the educational and more of the market commentary type of thing, because that's the sort of thing I tend to enjoy doing a lot.
All right. So, what interests me, and I think for many viewers, especially people who just don't even know where to start, right? So I've been in this industry for 13, 14 years, mainly on the platforms. But then I hear somebody, let's say like you, who's got, your specific niche, your profession, market analysis. What are the kind of tools that you use? How does one even start? Let's say someone is interested. If I had to take a guess, I'd say, market analysis, market research. You go to X.com, do we go to news sites, business, Bloomberg?
Yeah.
What's reliable? And, is there a certain strategy you follow, a pattern daily?
Yeah.
What are the daily tools that you use? And have they changed? Because you mentioned you're specific to gold. Could you use your knowledge with gold to, analyze other asset classes?
Yes.
But let's focus on the tools now. And there's so many other questions here. So,
well, this first thing I would say to the question you asked, if someone's thinking of getting started, because I also, like I said, I do education. The first question I would ask them is, why do they want to trade? I'll establish that first to make sure they have reasonable understanding of their motivation behind trading. Is it to build a passive income? Is it to build a portfolio? Or is it purely for fun? So I always ask that question first. Why do you want to trade? Once, obviously, we established that the main motivation is something of real value, then, of course, I would take my time out to understand the mechanics of why it's important to understand price movements or why something is valued at a certain value. Okay. Now, back in my day when I started, we didn't really have a lot of trading platforms. All our orders was done over the phone, filling in an order ticket, going from compliance, boom, the old-fashioned ways, ordering over the phone, a lot of fun. But back then, it was all about the fundamentals, understanding why certain assets moved, what makes, say, one currency more valuable than another currency. Understanding the reason and the theory behind that. So I'd always say, let's start from the beginning like I did. Understand why prices move, what causes those movements, as in why the market react, why those prices are important, and what makes one asset more valuable than another. What's the story behind it?
Is there a short answer to that?
Yeah, the short answer is, I guess, not really, because it's all different for different things. Okay, yeah, there is a short answer for that, actually. I can come with that. What is the need, or why is that price more valuable than something else? And the simple answer is, for example, currencies. So you've got the euro and the dollar, okay? How the economies are doing, because those bits of paper are all made of the same bit of paper, but if one economy is performing better than the other one, makes that currency obviously more valuable, more likely you're going to get that money, okay? Gold, what makes gold prices? What's the desire for gold? Why people need to buy gold? Often it's a safe haven. It's a hedge against inflation. What makes it a safe haven? Why is there a need for a safe haven? What's happening in the economy? What's happening in that? So it is a simple reason, just understanding the driving factors, the story behind such asset. And once you can get into the groove of that, not only can you find it fascinating and interesting, you can get a firm understanding. So, in the step, understand the mechanics, why something is valuable, what makes that price move, and why it's important for everything else. Yeah. To answer the other question, you said gold in particular. Do you look, or can you analyze gold and look at another asset which is linked?
Yeah.
Of course. Positive correlation or negative correlation is hugely important, understanding, because every single asset in one way or another has a relationship, even though they're completely not really attached. They do have a relationship. And it makes sense once you break it down. Why? For example, gold has a relationship with the Aussie dollar. Why? Aussie dollar, Australia is the biggest miner of gold. So if gold prices are doing well, obviously Aussie dollar is going to do quite well, because they're going to have to produce more gold, and the more gold they produce, the more money that coming into their economy for that gold obviously makes the Australian dollar stronger. That sort of thing. So everything is connected in one way or another.
I guess, it makes a lot of sense. But I think the complexity is just, there's so many other moving parts, because to be honest, I didn't know Australia was such a big, I thought South Africa might have been.
South Africa is number 2, I think.
Number 2.
Yeah.
Okay. And then there's also factoring in that the gold is always priced in US dollars.
Mm-hmm.
It's pegged there.
Yeah.
Right? And so that should also have a contributing factor.
Absolutely.
But then if you take the exotic pairs, ZAR, let's say South African Rand, and USD, and then you look at gold, is that correlation always consistent? Like if gold is going up, ZAR is going to go up, or which goes up? If USD is going up as well, I mean, it gets complex in my mind.
Yeah. I mean, look, there is an interesting story I remember in reference to South Africa. This is going back now, I think 2008.
Yeah.
Okay. This wasn't a major driving factor, but it was part of the story at the time. And this is just the build-up to the financial crisis. And this, of course, was when gold passed $1,000 for the first time. Because I remember when I first traded it, it was trading at $635 an ounce.
This was in 2008?
2006 I started. It was trading at $635 an ounce. In 2008 was the first time it passed 1,000. Up to that point, we all were saying, yeah, gold is that's the one to go for. Because there were certain signs like the US economy, and there was warning signs of the credit crisis. So during this build-up, gold was getting more and more exciting because the financial crisis was about to kick off. But another part of the story, which was also driving gold prices at the time, was there was a series of massive power cuts in South Africa.
Yeah, the load shedding.
Exactly. And that was the fear that went around the market. It was the fear it was going to affect supply of gold. So that also helped gold prices. Not that it was a driving factor. I think, to be fair, at the time, everybody was getting so excited about yellow metal. Any slight story was going to help the drive, if you know what I mean. So this story about South Africa and the power cuts back then affecting supply was another little feather in gold's cap for it to pass through the $1,000 mark. So though, like I say, little stories like South Africa, like that, can drive it, it's got to be part of the excitement at the time, if you know what I mean. You know, South Africa alone is not going to drive gold.
Yeah.
But if you've got every single thing in your little pot, every other story, and everybody's excited about it, it's the extra thing which could give it the extra push. But I remember that very, very well.
And then also back then was the crash, the housing market crash.
It was the
Gold must have shot up there.
yeah, that was the time when it went past $1,000. I remember it again. I think it was August 2008. I was in the Philippines at the time, running a floor at the stock exchange, and we got for weeks we were building it up. You know that there was telltale signs.
Yeah.
I mean, to be fair, I look. You know, this as a side note, I was doing mortgages back in the UK, and I left the industry in 2005.
Yeah.
I saw back then, when I was doing mortgages, this was not going to end well, because we had banks giving us 5 times the salary, 5 times people's salaries. They were allowing employed people to self-certificate as and say, okay, is my salary of 25,000 as a bank clerk, or by the way, I earn an extra 50,000 doing needlework for my nan, and they were signing it off. Yeah. Okay, they were giving it like a loan to value 100%, 110%. So I knew, looking at it then, that we were in trouble. This was going to end really, really, really badly, and that's one of the reasons why I wanted to get out. So when 2008 happened, I kicked myself, because back in 2005, I wish I knew what I know now, and I know how to take that knowledge as an advantage and make something out of it. But come 2008, when it was all kicking off, I was like, well, I knew this was going to happen. I could see it. And gold hit past 1,000 a day. Lehman Brothers, went pop, and that was the beginning, because nobody would have thought a massive bank of that nature would disappear. Yeah. And that was a really scary time. But for us gold traders, it was incredibly exciting, and we could pat ourselves on the back saying we were right all along. We knew this was going to happen. So
So gold what is it trading at now? Over 4,000.
It's just about. So it's coming up, I think, $4,082 an ounce.
Jeez. That is a massive jump. What's that? Like 500%?
Like I say, when gold hit $1,000 back in 2008, it then dropped down for a couple of weeks down to 800 and something. And then after that, the excitement came and it went past 1,000, and it has never been below that since.
And we had a recent jump, right?
We had a big jump at the beginning of tail end of last year and the beginning of this year, a massive rush.
What was that?
Well, I was very excited, because last year we were talking about gold had just gone past $2,000 a couple of years ago, and that was really exciting. But then all of a sudden it started creeping towards 3,000. And in 2024, I was talking about gold in 3,000. I mean, everybody was talking about hit 3,000. And then when it did hit 3,000, the beginning of 2025, I think it was, we were like, it's hit 3,000, finally hit 3,000. But then it didn't stop. That was the crazy thing behind it, because I'd never seen gold wrap this way. I've seen gold hit new highs and then drop back down and sort of range for a bit, catch its breath, and then, for a long period, all of a sudden, boom, do another one. But I hadn't seen it go this quickly before. It hit 3,000. We all got, that's it. We're going to lock in some profits. It's going to come back down a bit more. It's going to catch its breath and do what it does, and it's going to take us another year or so to hit 4,000. No. After that,
straight away,
within months, 4,000, and then 5,000. It got really, 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 really crazy. And I've never seen that. Now it has come back down. It's calmed down a bit, down to around about $4,082, I think it was, when I was going in. And that's the sort of, in my mind's eye, this is around the sort of the intrinsic value, the real value of gold. I think what we saw after it hit 3,000 was what we often call in trading the madness of crowds, where people just got overexcited and thought it was the next big thing and jumped in and got so excited they pushed it a little higher and higher to the $5,000 mark. I think excitement got the better of people, madness of crowds, like I say. Now the actual intrinsic value is realistic where we are now.
So yeah, this was one of the questions. One of the questions always had, and I think this is a question that most traders have is, when we talk about prices and what's driving prices, obviously it's there are headlines, and then there are the actual fundamentals. Like the tangible, the real world stuff. What is the actual value of this asset? And I think headlines, let's call it noise, is hard to differentiate, and is what creates the bubbles, and then there's the corrections. And can you tell, you specifically, tell the difference between what's noise and what's fundamentals? Are there any, certain factors you look at specifically? And I guess since gold is your main asset class that your expertise, what are those? Do we call them KPIs now? What are the metrics? What are the important things that you look at?
When I'm trying to establish the intrinsic value of something, and I think what drove the initial madness for it to go past 3,000 was the amount of central banks buying gold reserves, physical gold reserves. That's not often headline news.
Those are gold bars sitting in physical storage.
The actual physical purchase. That's not headlines. That was something which, obviously, those who read and keep up to date, everything, the information's there for us to see. It's not headlines. It's not like China buys this amount of gold. That's not headline. You've got to look in the nitty gritty to find that information. But when you can start seeing buying activity, physical buying activity, like we did near the tail end of 2024 and beginning of 2025, those of us knew, okay, this is going to go, because they're actually physically buying it. The central banks see the value behind it, and they're worried about something. And then the other fundamental aspect of it, you look at the two driving factors of gold, which is obviously safe haven aspect, or what makes it safe haven, and why is it safe haven. Oftentimes it's of geopolitical consequences, wars, things of this nature, and there's that brewing. Then you're thinking, okay, that could be the opportunity for gold. And the other one, of course, is economic strife. Now, a lot of us knew when Trump came back in, he was going on with his tariffs stuff. And it doesn't take an economic expert to realize tariffs are a very bad idea, especially for the global economy. So, of course, when that started coming about, and it was headlines, tariffs, though they were not automatically linked to gold, the rest of us knew, okay, this is going to damage the economy, the global economy. Gold is going to be...
I'm going to rest my money there.
Exactly. It's going to be very, very desirable. Because for one, this is going to slow down the global economy a lot. B, it's going to increase inflation a lot, which also means, in the long-term picture, central banks like the Fed, Bank of England, etc., are going to have to either raise rates, but economically you're going to find them in a position where lower unemployment as well, so you're going to have stagflation. We're betting on lower interest rates, of course lower bond yields, which also makes gold more desirable. So that was the driving factor. So again, it's just understanding what role gold is playing in that time. Is it safe haven for economic issues or safe haven for geopolitical issues? So as long as you establish that and see which headline is connected to which story, not literally saying headline gold, but you understand, okay, this could be interesting for the yellow metal, or this is going to damage yellow metal in the long term. That's how you can sort of get an idea, a picture of where the yellow metal may go, so to speak.
Yeah, it's interesting how you hear many different professionals, investors, traders, market analysts, different perspectives. I'm hearing yours, and you're saying, gold is the safe haven. Many people have that sentiment. Many.
Yeah.
But then, what if something happens and gold becomes something that the market doesn't care for anymore? For me, it just feels like it is, again, a risk. I would, same thing as real estate. There would be many people who would say, sink your money in real estate. That's never going down, gold, I mean, it does seem reliable, but there's one, I can't remember where I read this. This is Sean O'Reilly, I think is his name, Mr. Wonderful.
Okay.
One of the sharks.
Okay.
Yeah. This made a lot of sense to me. He said he follows a strategy of don't ever let your total portfolio be overexposed more than 5% on different uncorrelated asset classes. So you got 20 different asset classes, tech, real estate, gold, whatever, and then manage your portfolio. If one goes a bit more overexposed, cut it back, spread it across.
Yeah.
That diversification for me, I'm not a trader. For me, feels a lot more secure because, and also, you know, I'm one to speak. I don't do anything like this. I'm super high risk freaking startups, you know, until I'm able to have this extra, you know, revenue where then I will follow that strategy, or maybe I'll start with gold, whatever. But it's a question I think that many people I think have, and especially the audience would appreciate, is how do you know that gold is that safe haven? What are your guarantees? The world is so unpredictable. Gold was once upon a time 600, went to 1,000, reached 5,000, now it's corrected back to 4,000. Is that noise? Can it go back to 2,000? You know what I'm saying? If if I go and I listen to this podcast and I say, and again, this is not investment advice, we're just having a conversation.
Of course.
And let's say, you know, we convinced someone over here, somebody looked into this conversation and said, oh, okay, gold, let's go. And I put all my money in there. And then for some reason, it goes down to 2,000. It's not impossible, right?
No, of course not. Of course not.
So what's your opinion there? I mean, the diversification and...
diversification is key. Just to, obviously, for the audience to understand, when I say safe haven is an asset where the markets moves its money into of times of uncertainty. Safe haven doesn't mean it's a guaranteed investment.
Okay, that's a good clarification.
Not at all. Safe haven is an asset where, like I say, the market's nervous, mainly driven by maybe geopolitical events or economic events, which the market goes, oh, a bit scary, the stock market's looking a bit shaky, let's put our money into something a bit safe, what they class as safe havens, like the Japanese yen, like the Swiss franc, like gold, for example. Those are what's known as safe havens. I'm not saying safe haven doesn't mean guaranteed success. That's a total different word. In answer to your question of diversification, I completely agree. You know, there's an old English saying, you never put all your eggs in one basket, because that's insane. So you do diversify. I probably would look at more negative correlations in my portfolio. The way I look at that is that if something is going up, the other thing is going to go down. But if I'm wrong on one thing, this is going to go the opposite. So I'm sort of slightly hedging myself a little bit. But yeah, by all means, diversification in your portfolio is vital. You know, you don't put 50% in gold or anything like that. It'd be silly. You know, gold is there for a rainy day if everything goes wrong. You know, so by all means, diversification is vitally important. And again, it does depend how your portfolio is set up. It does depend, of course, on your attitude to risk. You know, are you a high flyer? Do you like the adrenaline rush, the excitement? And then, of course, you would probably go for more high returns but riskier assets. If you're more level-headed, slower returns or assets aren't so exciting, but are likely to, over time, potentially give you a good return on your investment. So again, diversification, yes. How to diversify that portfolio? Again, it's down to you and how your attitude is to risk.
I'd like to hear your opinion on what I've heard in this market where many times gold is being compared to Bitcoin, the digital gold. What's your opinion on that?
For the record, it's not a big surprise to people who know me. I don't like crypto at all. I don't like Bitcoin. It was a couple of years ago, 2016, I think it was. Bitcoin really started to fly. And at the time, I was asked to write lots of articles about the market, and I had to write a load of articles on Bitcoin because it was the main news. And one of the articles I wrote is I did compare Bitcoin to gold and asked the question, is Bitcoin the new gold? Now, I think in reality, at the time, there were serious questions of it being like gold, as in being a safe haven. When things are nervous, you move your money into gold. When things were being nervous, people moved their money into Bitcoin. Back then, that was a case. You could see that. There was an incident around 2016 where, it was 2017 maybe, where North Korea and US started getting a little bit, started to kick off a little bit, saying nasty words to each other. And gold skyrocketed because obviously geopolitical issues, safe haven status. At the same time, Bitcoin moved as well. Same time, same sort of length of direction, same, as gold. So then people start, it's going to be the new gold. It's going to be the new potential safe haven. When everything goes wrong, they're going to move their money into safe havens, Japanese yen, Swiss franc, gold, and now it's going to be Bitcoin as well. Bitcoin's the new gold. It's the new safe haven. Back then, there was an argument. Now, totally opposite. Now, Bitcoin role is complete risk on. When things are a little bit optimistic, when things are a little bit, everything's looking great, the Mag 7's performing well, Bitcoin tends to do really well. Whereas gold is obviously not doing well because it's there to be jumped into when things are bad. So there was an argument for it back in the early days, back in 2016, 18 time, yes. Now, no, totally different. Totally different behavior.
I think because of its nature, there's so many arguments there, but because of its nature, it's so volatile that just 6 months ago, it was over $100,000, if I'm not mistaken, and now it's sitting at $60,000. That's massive.
It's huge. I mean, we're talking about gold going down below $2,000. By all means, that is possible, but
much more difficult. Yeah,
you would have to have a serious, really serious issue happen for gold to do that dramatic move. I mean, it's not impossible, of course. But the nature of the two assets are very different now. One is pure risk on, one is pure risk off. It sounded like a scene from Karate Kid. But yeah.
Here's another question. When you look at index funds,
yes,
you hear like Tony Robbins speak about. Put your money in index funds. There's a consistent year-on-year, decade after decade, 6-7% rise. Is there that kind of consistency with gold? What is gold over the 20 years?
Okay, the only consistency you have with gold, is that when you have a bear market, and this is the reality of the way the global economy works. You have boom, boom, bust. You can't always have boom, boom, boom. It doesn't work. You're going to have boom, boom, bust. How bad that bust is depends on circumstances at the time, how bad it is. Now, the one consistency you can see with gold, every time we've had the bust, as in we've then had a bear market, gold has always come out on top as an investment. Always has been. And it's been one of the best returns during bear markets over the last, I would say, 20 years or so, even longer than that.
So is that in meaning that the bust, when it starts retracting, when it starts going down, is not as severe as other investment instruments?
As in you mean as gold will?
Yeah.
No, I guess again that's guaranteeing that it's always going to be quite level-headed. Gold is not level-headed. Gold can be incredibly volatile. I'm just saying that one track record you have with gold is that gold has in the past always performed extremely well as an investment during bear markets. It's had an incredible amount of returns over the years. So when times are bad, then it's always been the asset to go to. And the reality is we are going to have bad times, because you can't have a global economy just booming, 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 booming. You've got to have boom, boom, bust. You've got to clean the slate and then boom, boom, boom again, bust again. You've got to have it. That's the way it works, you know.
Yeah, super interesting. You look at the graph. There's this. It's this wave that since the 60s, it's coming to my mind, where it goes up and then there's always a retraction and it always goes up, and that's what you're referring to, right? The boom and bust.
I'm referring to like the global economy, because like you say, you have a global economy goes up like this, then we have say like the dot-com bubble.
Yeah.
So we then have a bust period of time for the global economy, when all the indices and the market goes down, and then of course we all pick up again, so boom again, and then it goes boom again, and then of course we say financial crisis, the credit crisis, bust again. You know, where it needs to reset. So during the times when it's dropped back down and this becomes a bear market, that's when gold has always excelled, always had the best return.
Interesting. Let's move on to other topics around. So, are there any other asset classes that you trade on, or is it, or that you speak about and educate?
To be fair, I speak about the whole range of assets, including cryptos as well. Even though I don't like them, part of my role, and you know, I do have to talk about Bitcoin and other cryptos and discuss, you know, the mechanics behind it. But I also talk about obviously indices. Stocks, shares in particular currencies, I've been doing for years.
And One Royale's main market is licensed in Cyprus?
We do indeed have a number of licenses. We have ASEC, we have obviously CISEC license, Vanity license as well, Seychelles license. So yeah, we've got a number of licenses. So like I said, the company itself has been in existence for say 20 years. So, which is a good sign in this industry, to be fair, because I've worked, you know, a number of brokerages have lasted this for 20 years is very unheard of. Which is, you know, something One Royal is very, very proud of, you know, and they should be. But we offer a wide range of assets, you know.
Direct market access, or is it all CFDs?
It's CFDs, okay. There's futures as well. You know, it is obviously straight through processing, so e-book as well. ECN accounts as well. So again, straight through. So yeah, you know, we offer a wide range of different asset classes. Again, which goes back to our point we're talking about diversification. One of the things we do, or I do teach in sort of the educational shows and stuff we do talk about diversification and why it's important, and the amount of assets we provide or are available gives the client the opportunity to diversify as well. So that's always important.
Interesting. Are you using AI in any of your day-to-day?
Myself personally?
Yeah.
No. However, I know AI is the buzzword and everybody's so excited about it. Obviously, One Royal does provide AI trading signals and AI technology for people to trade with. The most I use AI for, personally, is to just quickly remind myself as what's happening in the world. You know, and make sure the sources it gives me is correct.
So you do use AI. I mean, you know, when one talks about AI, it is a buzzword. I agree, but I think it's there's a very real core reason it's a buzzword. It's actually already happening. It's part of our lives. Maybe people don't even realize it yet. You know, it's interesting. I asked you the question. You said, "No, I don't really use AI," but you use it to help you market research.
I use it as a search engine.
There you go.
Which I shouldn't really. I mean, there's other search engines. Here's the one thing with AI, which I think I spoke about this at a conference in Dubai a couple of months back, and though AI is a new thing, it's not really a new thing when it comes to trading. I'll say why. AI is new for the retail investor, okay? However, financial institutions like the large banks, the big boys, they've been using technology, black box solutions, algorithmic trading, machines to calculate, or programs to calculate, for years. So in many ways, they've been using their version of AI for many, many years. So it's only now really starting to come to the masses, to the retail market, where we're starting to be able to use it. So it's always been there. It's just now more retail friendly, if you know what I mean. It's easy for anybody to go into ChatGPT. What do you think about the cable, the pound, US dollar? Where do you think the levels are? We can do that, but banks have had that sort of technology for years. So it's a buzzword for the retail market. Yeah. The big boys have always had something similar already, and they've been doing it for many, many years.
Yeah, I think the main distinction there is, the banks have obviously had their technology that has been improved year after year, but very niche and specific to that task. And I think the more accurate description there is automation. So where you give it very fixed rules, what humans would have normally done in terms of their investments, right? Hedging or whatever it was. Humans obviously before that based their decision on some core rules, right? And you can build that into an automated system, an algorithmic script that decides and automates that process based on what the humans. What's happened now is that it's become more general purpose, where and then this is the thing where the convenience of natural language translates into, and this the AI today understands natural language and breaks it down into very specific rules and executes a task very accurately. From someone who doesn't even, might not even have.
You bring in the power of Prometheus' fire to the people. In lay, you're giving it layman terms because it's easy to understand and you can put it in yourself. Whereas these black box solutions, which banks have had in the past, they're a lot complicated by very intelligent people who program them and put them into place. So you are basically making, more of a giving power, like I say, to the masses, making it more easy for people to access it, so to speak, and make it understandable to them. So you can understand, like you said already, a simple explanation of what they need to do. I mean, the whole point of using technology like AI or like black box solutions, end of the day, is to take away human emotion, because we're emotional beings, you know. So if we can take away our emotions, it's going to make more rational decisions, which hopefully more rational decisions mean more successful decisions. That's the idea behind it. And that's why it's been successful, right? Not perfect, of course, because you've got, you do have flash crashes, of course, where technology gets it wrong and you have the big drop in the market as it then, makes a mistake, like a human does. But, when a human makes a mistake, we call it a fat finger. When a computer does it, it's a flash crash. But it's not foolproof. Absolutely not.
Yeah. So just back to gold, would you think, and just looking kind of in the next 5 to 10 years, and one can talk about the general advices: buy on the dips, always buy on the dips. But that means you have to sit and look at the charts every day and say, is this dipping now? What if I had to decide on the first of every month, I'm going to take whatever money I can afford to lose and just sink it into gold and do that over the next 5 years? What is your, maybe not just gold. Would you think that is a good idea generally to do?
Like I say, I do like position trading. So where you hold your trade for a long period of time. I'm not really necessarily into
Day
scalping
trading,
or
yeah.
day trading. I like to, again, try and see what the intrinsic value of an asset is, and try and guess when that intrinsic value is going to be reached, or is it already reached, or is it overvalued. When it comes to, say, something like gold, for the rest of this year, I tend to feel unless something really drastic happens, the excitement behind gold is gone for the rest of the year. I think we are, we're around the right value of it for now. It's going to be range bound for the remainder of this year, mainly because of the current situation, like with the Fed likely to raise or potentially hiking rates at some point. This on and on tension with Iran, it was basically where we are. We're going to range between most likely about 3,800 to 4,200. So we're there. We're not going to expecting any moves. In the future, however, in the coming years, I do see gold going higher again. So as a potential long-term investment, I would look at putting a little bit in my portfolio into the yellow metal, but holding it for a good, like you say, 5 years' time, not expecting an instant win. I can see gold being more and more attractive because, like I say, I've seen it over the last 20 years go from here to here, and I think the way the global economy is set up in general, we're not going to be able to break what's known as a K-shaped economy, which means in time there's going to be more economic strife. So I think in time gold will still be very attractive in the future.
What's a K-shaped economy?
A K-shaped economy is basically where those at the top, like billionaires, a lot of money, control all the assets. Whereas those at the bottom, we can't, because they have everything. And we are getting a very big K-shaped economy where those who do have a small percentage are keeping the stock market high, are doing this, where the rest of us at this stage, the lower a bit, aren't able to buy property, aren't able to do that.
Because they've got the buying power,
Because they
set the price up there.
They've got the buying power, and they will go and buy more and make it more difficult for us to buy. Because if they're willing to pay this amount, how can we get started? You see what I mean? That's the way the economy is at the moment, and that's likely to continue for a bit longer. Which means in the long term, gold, because you can't survive like that. Eventually, you can't survive. You can't keep going like that. So eventually, you're going to have a bit of a crash, will make gold attractive in the coming years, definitely. In my opinion, not advice, everybody.
Yeah,
of course.
Yeah. This is not advice. We're talking. That's interesting. So, okay. Let's talk about One Royale. How does one start? Do you just go register? Is there any minimums? Are there any charges that people need to know? If I wanted to go and invest in gold or whatever it was, what's that whole process like?
Okay, like I say, it's like any sort of forex broker process, but we keep it at One Royale as simple and as easy and as friendly as possible. Obviously, you can simply register an account, okay, with your details. You would obviously have to provide, proof of identity, proof of residency, the usual KPI. You need to, not KPI, sorry,
KYC.
KYC. Thank you very much. Usual KYC you have to provide for opening any trading account or any bank account for that matter. Then, again, down to your level of or attitude to risk, there's a number of accounts, classic accounts, of course, which is standard. Then you have ECN, which means it's very thin spread.
ECN stands for?
Electronic. I can't remember, and they caught me out.
Let me try
to
and
remember.
It's let's ask ChatGPT.
Oh, yeah, it's cheat. It's just ChatGPT. Actually, yeah, showed me up. I can't remember.
ECN is. Let's try and challenge our brains. This is where AI, I think, is going to take away some of our abilities.
It's just lazy.
Let's try and remember first.
Yeah, we don't need to. Let's check. Let's ask Claude.
It's ECN is network, so it's electronic communication network.
Something like that. Something like that.
And let's do this for the podcast live. Let's speak. Can you hear me?
loud and clear.
In trading, what does ECN stand for?
ECN stands for Electronic Communication Network.
There you go.
It's basically a system that matches up buy and sell orders directly between traders.
Buy and sell orders between traders.
Yeah.
Yeah, so you get tighter spreads, more transparency, less middlemen. Great in theory, but it also means liquidity can be.
Just a question: does that mean that the trader actually has access to the actual market, or what's the difference between, let's say, ECN and a broker offering CFDs, or am I mixing two things that have no relation at all?
Let me just run that. Right, so the two are related, but they're not the same thing. So a CFD is a type of product.
Derivative.
Right, a derivative that tracks some underlying asset. ECN is about how the order gets executed. Now, a lot of brokers call themselves ECN CFD brokers, meaning they route the CFD orders into an ECN or a liquidity pool. But you're still trading a CFD and not the underlying asset. An ECN doesn't magically turn a CFD into a physical share or spot asset. So yeah, they're related in practice, but the CFD is the product, ECN is just
It's the execution.
model.
Yeah.
Thank you.
I have a quick question.
Yeah.
What shall I wear today?
One sec. Given the heat today, nice cotton shirt, chino shorts, and breathable trainers.
Thank you very much.
Smash on the sun cream and take some water.
I don't agree with the sun cream. It's good. It's good to get sunlight. Vitamin D is super important. But thank you. And geez, this ChatGPT has become freaking brilliant.
I tell you, mate, you're right. This is going to make us lazy.
Yeah.
We don't have to remember anything now.
Yeah.
We don't even have to think about what to wear.
Yeah.
What shall I eat today? Or tell me what to eat.
Yeah.
Excellent. Yeah. Very, very good. Thank you, ChatGPT. You're fighting my argument really well, helping me out there.
So we were talking about One Royale and
Yeah.
ECN obviously reducing charges.
ECN, obviously one of the main benefits with ECN, of course, obviously is this, because the execution is better, the spread is lower. Okay, so you're less likely, spread from zero. However, of course, you're going to pay, because the broker's got to make money, you got to pay commission, round trip. $3 in, $3 out. So that's your commission.
Is that $3 per lot?
Per lot, yeah. So that's set, of course. Unlike obviously if you're dealing with a non, commission-based market, again, it can still happen with ECE. Obviously, the spread can change. So you may only pay, say, 2 pips in. When you close, because of volatility, you can end up paying 7 pips out. You know what I mean? So you still get those sort of dangers. That's trading in general. And obviously we have VIP accounts, But I think what's more important, one thing I would like to say, what makes One Royal stand out, other than from all the other ones, is like I've already said, we've been around for 20 years. But it's the personal approach we tend to do, And this is one of the reasons why I'm more than happy to represent them, because I always tend to feel financial services has to be personal. People are individuals, they're not simple numbers. You treat them as people, and One Royal's attitude is treating everybody as an individual, not simply as a number. And we do our best to support people, educate people, hands-on with people, building relationships with people, which is what financial services should be about. You've got to bear in mind, majority of clients will never meet the person they're talking at the end of the phone in person. It's an online business. Mm-hmm. So that relationship building over the phone or through whatever forms of communication has got to be vital. They've got to trust you. They've got to know you. You've got to build that relationship, and that's key. And that's something which I think One Royal is very. I'm very proud to represent One Royal because that's the attitude. We try and do our best for individuals, and we treat individuals as individuals. So that's the main thing I'm proud of.
Awesome. What technologies are used there? Is it MetaTrader 5?
MetaTrader 4, MetaTrader 5 are obviously the main trading platforms as well. Like I said, I mentioned already, we have got, of course, AI signals. We have partnerships with a number of other technical analysis companies, Security being one of them as well. And in fact, we have a very large educational packages which are coming soon, which of course I'm going to be one of the driving factors behind.
And are those charged, or is it just?
It's part of what you get when you join us. You know,
As long as you're a trader.
as long as you've got a live account, you know. Certain obviously aspects like sort of VIP accounts, you're going to get a little bit more, like one-on-one sessions with me in the future, conversations with myself, conversations with my analysis team, things like that, of course. But in general, just have an active account. And even if you're new to trading, we're here to help. You know, we have so many tools of education to help you, you know.
How many people are employed in Montreal?
We got a number of offices. Obviously, the main headquarters, of course, is in Lebanon. Obviously, I'm based in the Cyprus entity. Close to Surrey altogether, maybe 300, close to 300 people.
Yeah,
you know.
Yeah. People need to appreciate how difficult it is to run a brokerage firm. I mean, there's so many different moving parts. It's business critical. You're dealing with people's money. There's the customer support element. There's the the trading platform admins. It's the compliance, the regulation. I know, I'm in this industry and I can see it's not easy.
It's not. It's there's so many factors you got to get into it. It's marketing to the public, making sure people know that you exist. It's obviously customer support. It's obviously making sure you stay compliant within the rules of the law and you don't, you do the right thing, of course, at all times. But one of the massive, massive things which so many brokers overlook and so many brokers fail because of this is the risk side of things. They don't take into account their own risk. I can count a number of brokers I've known who've gone bust purely because they made a mistake of concentrating getting the money in and people in, but not looking at their exposure at the other end. That is hugely, massively important. And so many brokers overlook that, and that's a massive part. Because you've got to make sure that all your positions are covered, you're hedged, and your exposure is not too massive. Because otherwise you're in trouble. But it's a massive, massive thing to. There's so many. I've come across so many like IBs in the past. You've been very successful at IBs, very successful bringing business in, and in their mind's eye, they go, "Oh, the next big step will become a broker. Let's come and be a broker. Let's go and get a license. Let's be a white label. It's easy. I'm so good at the IB business. I'll be so good at being a broker. I'll make more money." No, they won't. No, they won't.
Because the IB business is just one small little segment, and that is just marketing.
Exactly. Marketing, bring them in, take your commission. Oh no, whole different kettle of fish. You've got compliance, you've got this, you've got exposure, and they just have no idea of how much is involved in actually running a brokerage.
100%.
No idea.
I like to look at risk. We don't do any risk management here in DJ. We're just platform admins, and I've had many brokers ask us, "Do you do risk management?" I just don't want to go there. It's a big responsibility.
It's huge.
And we're not going to beat that. And also, we don't need, as a tech provider, we don't have much regulation. But if we go into that realm, we need to get regulated because we're dealing with people's money. But I like to make things simple, right? I break it down and then from there go in depth. But for me, when we talk about the risk management, specifically for a broker, this is the simple approach that I would apply. First you need diversification in terms of clients.
Of course.
If you've got only one client trading with you and you're taking on that risk, you're exposing yourself. And so we've spoken about, STP, don't take the risk yourself. Take that trade, pass it on to the market. That's the best you can do in terms of risk management. But as you start growing bigger as a broker, it is not your business. You could be the market maker, but the market making, in my mind, isn't taking a risk. If you've got the sentiment of your total client base, let's say there's 3,000 clients trading, and 20% of them are going long on the euro dollar and 80% of them are going short, you're exposed
massively.
That's not market making. That's relying on the statistics that traders normally lose. But you can, that's dangerous. For me, it's always bringing it back to the middle. Always bring it back to the middle. If there's 20/80, take that 30, pass it on. Bring it to the middle every single time. Because as a broker, you're charging your commission and you've got your spread. And that's not, we're not, the broker's a business.
Of course.
That's it. And that's where your money is. Not in the clients losing.
No, it's for the volumes is what you want.
Correct.
Just to go to your point, by all means, when it comes to exposure, you need to look at the whole picture. You also have to be aware that even if you're passing stuff onto an STP, the idea is, okay, that's going to cover you. It's not always the case. I can remember a certain time, back in January 2015, when a certain national bank upset the whole world.
The Swiss franc.
Correct. When the Swiss National Bank suddenly removed the peg without telling anyone. Because usually there's a rule between central banks. Usually if the ECB is going to do a rate cut or the Fed's going to do a rate cut, Bank of England, Bank of Japan, they will call each other like a day before and tell them, by the way, we're going to do this. Just prepare yourself, make sure you're okay, you're not overexposed. The S&B didn't do that. So they did the peg. So my point going back to even doing STP, you're not safe. There was a number of brokers when that happened, because they were so overexposed in the Euro Swiss franc trades. The next day, liquidity providers were calling them up going, by the way, you owe us this amount. You owe us this amount. You owe us this amount. And the likes of obviously Alpare UK, God knows, went bust overnight.
Because there's a big difference here. Just correct me if I'm wrong.
Yes, by all means.
The B2C broker, so the Alpares of the world who offer trading to traders, the regulator, I don't know, I can't remember back then, but the regulator protected them against negative balance. So you weren't allowed to go and ask them for more money than what they initially invested.
You can't. If a client loses 100,000, but your loss is 300,000, you got to come up with 200,000.
Yeah, because on the B2B side, institution to institution, there's no negative balance protection.
No, exactly. Retail market, of course. If I've invested 100,000 and I lose 100,000, that's my commitment. I've lost 100,000. You can't come back to me asking me for another 200,000 if my loss is 300,000. Whereas brokers, you've got to cough up, son. I'm afraid, mate. Yeah, sorry. You don't have that. You don't have that protection. You owe us, and it's your fault for overexposing all positions on Euro Swiss franc. You should have been edging against the possibility of that happening. You should have been smarter. You bad little man. So what I mean?
How would you advise a broker then cover their risk?
Again, I would break it down to for one, how many positions I'm stacked in one particular asset. For example, am I overexposed in gold? Or if I'm overexposed in oil, what is the story as well? What's driving the market? There was a broker I know, for example, made a silly mistake on the spread on the Turkish lira. And this was at a time when the Turkish lira was just doing that. And every dealer, every analyst on the planet knew it was only going to go one way. And they just thought, well, let's get the money in. We'll make low spreads. We'll do low spreads to get the Turkish lira business. Didn't count the fact that it would carry on dropping. So obviously a broker needs to know what's going on. A risk management department needs to know what's going on in the market. So you know what the story is and know what assets they're exposed in. Okay? And then if you are overexposed in a certain direction, of course, then you obviously hedge yourself. If you agree with them, you go in the same direction. If you don't, you go in the opposite direction. Make sure that you've got that for protection. And always think of the most unlikely possibility might happen, because we never know. I mean, S&B, we never knew that was going to happen. Yeah. Nobody knew. So you've always got to be wary for that. Be on the safe side of caution, because these markets are all about catching you by surprise. It doesn't happen a lot. Not as much as it used to. It used to be fun. Now it's a bit boring. It takes ages for something nice and exciting to happen. But it still can happen. Yeah. You know what I mean? And the other thing you need to look at as well for a broker, is what so many brokers don't do, you need to look at client behavior. You know, have a look at them. You know, see what...
There's something telling there.
Yeah, what's their trading strategy? Have they found a chink in our armor? Are they getting us for latency here? Are they getting us for... Are they arbitraging us here? You need to look at the client and see what their trading activity's like.
On that sense, yes, you might have a chink in your armor, let's say specifically to your ecosystem. But I think also your clients are little agents. If they're looking at the markets, each one of them are doing their own research, their own reading. You know, some are going on X, some are looking at news, whatever. And it's telling. They're giving you a story of what's going on in the markets without you even, as a broker, needing to pay for that analysis.
Well, yeah, there is that as well. You can, you know, the madness of crowds, for example. If you go back to that, if you can see there's a community or a number of people trading a particular asset in a direction, you can sort of get what market sentiment is related to that asset. Because at the end of the day, the market's all about the number of buyers and number of sellers. So you have more buyers doing this, that means obviously bullish. If you have more sellers, that means obviously bearish. So again, you know, you can ascertain that. But I think looking at client behavior is really important. Understanding how they're thinking and making sure that you're not being put into a position where you're going to regret it later, so to speak.
James, it's been a pleasure.
Brilliant.
Yeah, I think we've been speaking for more than an hour here.
Just about.
Yeah.
Yeah.
Let's move on to some closing comments.
Absolutely.
If you want to bring up something that maybe we didn't cover in our conversation over here.
Not to be totally open. I think nothing that comes to mind, to be fair. You know.
So yeah, where can people find you? You want to close on?
Okay.
James?
Well, yeah. Of course. Obviously, you can find me in my shows, which I'm starting a brand new show very, very soon called That Trading Show, which is going to be like a podcast live show.
Cool.
You can find that obviously on our YouTube channel, our blog, everything connected to One Royal. Those, attending the Money Expo in India, I'll be there. I'll be going to a number of events around the world at some point this year, Rome included, in November. I'm going to like that one. That one I'm looking forward to. But yeah, you can find me obviously through One Royal or social media aspects. You can see my ugly old face everywhere because it gets everywhere. But yeah.
Nice.
Brilliant.
Thank you very much.
Yeah, it's been an absolute pleasure. And thank you, ChatGPT, for showing me up, by the way. I appreciate that.
Yeah.
Taking over, showing me up like that. I don't know. Thank you, my friend. It's been
Thank you,
absolutely
James.
brilliant.
It was great.
You.
Awesome.
Excellent.
That's a wrap.